Good evening, traders. It's Wednesday, November 5th. It's about 4:45 p.m. Just a recap on what unfolded today in the markets, a quick recap, and then we got a bunch of questions and comments from members to go over and touch on a few interesting points here. So let's take a look at the NASDAQ. We did see it go oversold yesterday. We're talking about how there was panic selling. How usually when we have a day of panic selling, we tend to see the market have a rebound and a bounce the next day. We saw a nice bounce today from that one day of panic selling. We also talked about yesterday in our evening update how the market had given us this cycle low. Whenever we get these cycle lows, with which we can see these cycle lows with my green cycle indicator, the lime green, the bright lime green are the cycle lows, the strong ones. You can see how they pretty much standout lows in the market, and that's what happened yesterday as well. From there, we tend to see the market have a bounce. And the big question is, are we going to get some follow through in the next couple of sessions and see this market be hitting all-time highs again, or is it going to run out of steam? If we have too much selling, too much downward momentum, and it drags out for too long, it will kill the trend. So that's, we've got the short-term pivot low, boom, that has kind of been done. Now we need to see if there's follow through for this to go up over the next several days. Today, yesterday we saw money flowing out of stocks into bonds. Today, we have the market flowing into stocks and out of bonds. Bonds had a really big pullback today. Let me just clean some of this up. TLT had a big pullback down 1.1%. So definitely some money moving away from that space. We did see money move into gold. We had gold up about 1%, just over 1% today. Again, still trying to carve out a bottom. There's a lot of fear. Believe it or not, it went from everybody wanting gold to now people are scared to get into gold. And so there's still that trickle of selling pressure in the space. But we did see money really move into gold and silver miners. Actually, more so just gold miners. Gold miners up about 3% on average today. Silver miners are the difference. They're actually closed negative. And I think part of that is as you get to more and more volatile things, you have smaller markets, so they move faster, and generally more emotional traders involved. And so, for example, when we look at gold is pretty big. Percentage-wise, it's not a huge percentage. It's very controlled, the sell-off, other than the one-day drop that we had. When you go to gold miners, they're not, they're bigger, slower moving, a little more controlled. And it takes a lot more pressure to kind of wind those down. And then we move to the silver miner juniors. And of course, it's still people panicking because it's a big percentage move. And, people get into this to make more money, but keep in mind, the knife cuts both ways. So when it goes against you, obviously you can lose a huge chunk very quickly. So it's the fast moving stuff. It still has fear and people selling, and it's kind of carrying over. So I do think we're very close to seeing a rebound here. And as I've always said, gold is the most stable, it's the most consistent winning trade when it comes to using technical analysis. So I would prefer to have a bunch of winning trades that don't make as much than try to make a bunch more in more volatile things and actually lose more of those trades and go through the whole emotional roller coaster ride of 25% corrections in a week and a half, 2 weeks type of window. Crude oil started to head down today, starting to show a little bit of weakness and rolling over again. It's in a downtrend. I'm not too excited about it. If anything, I still think it's going to be heading much lower over the next several weeks and months. But again, not a whole lot of change there. So I want to jump into a bunch of questions and comments that members have here because there's some really interesting angles on the markets. So let me see. The first one is, one of the members is asking us, and Brian's our options trading expert, Brian Benson. One of the members is asking, they're curious if, because we've been trading for 25 plus years, if we find the markets, the movement that we have back and forth here, do we find it exhilarating or frustrating? Now, I can't really speak for Brian, although I would like to think, we need volatility. We need these emotional swings in the market to create opportunities. And that's why I have built all of these tools to tell us when there is panic selling. So that's, people are emotional, but we get a read on it. When somebody's scared, you instantly don't become as scared anymore. If you're alone in the woods, you're pretty darn scared at night when you hear something. And then when you're with a friend, they're freaked out more than you are. You don't seem to feel as scared anymore because anyway, once we know everyone is scared, it's actually an opportunity. It actually lightens the load. We're like, okay, I know where this is going, most likely going. And so I find the volatility actually exhilarating. I find it fun to watch. It makes the markets more exciting. Obviously, I don't like it when trades go against us and we're getting things tested, but overall, we need these extreme and these swings because that's what creates profit taking, is what creates new trends and all of this stuff. So I don't find it frustrating. I've given in a long time ago that I don't know what the markets are doing. I just follow it. And I know it's not always, it's going to flip and flop sometimes. We're going to have losing trades. I know things are manipulated to some regard. If you think about all that stuff and worry about it, trading isn't fun. So you got to give in and just understand the markets do what they do. And you just need to be on your game to identify how to follow trends and identify opportunities. One of the members I made a comment last night about something about capturing a 15% move. And I think that was talking with gold here. So we did a gold trade. They're wondering how, what this 15% move is when we didn't make 15% on our band strategy or our ACS strategy. Again, the key, and I know I move fast and I jump time frames from long-term to short-term time frames and in strategies. I know it's not always easy to follow me, but when I'm, for example, for this 15% move, if this is the one I'm talking about, if I'm on the gold chart and I say we caught a 15% move, this is the trade that we caught. This was a beautiful 15% move. We caught that move. We did hit a first target somewhere up here. We locked in partial gains. We got the rest out at 15%. It's not that our whole portfolio went up 15%. I'm just saying we caught this 15% move on the chart. And by managing our positions, obviously we make less than that specifically. And maybe, Stephanie, I was talking about the stock indices when we had the market rally and we hit a 15% target right up here, something like that. It's not that we make 15% on our portfolio. We hit targets and we scale out at these levels. I'm just saying we can reach these moves. So I probably have to find a better way to word some of this stuff so you don't think our whole account jumps up by 15%. We caught that much of a move on the chart and then, net out in the end when we've scaled out and locked in our gains and changed trends, it's going to be a different amount. But the key is we want to identify these trends and take advantage of them. So another comment here was from Rodney. He was talking about how the money was flowing out of the markets. This was 2 days ago. It was a kind of a broad market move. Everything was flowing out of stocks, metals, Bitcoin, etc. And he's saying, where is money moving? If money's moving out, where is it going? If money's always looking for a return. Well, I kind of replied back here and I just talked about, the money was flowing into a couple sections, a couple sectors. We saw money flowing into real estate and a few other sectors. So some of the money flowing out of the majority of the stock market and sectors were flowing into some other sectors that were positive for the day. But we also did see bonds move higher, which is a huge market. So it can absorb some of the selling pressure. This money coming out of stocks can go into bonds. And then I also shared this chart. When we look at the US dollar, like the currencies, sometimes people do move to cash. And money's been moving into the US dollar. And people are just liquidating and they're worried about things. So again, sometimes money doesn't always chase big returns. I mean, going to a savings account, you're still chasing a return. It's just not much. You're going for safety and to make a little bit. And so cash is one of those big positions. It's something we use all the time because sometimes between trends, the best thing is to just sit on your hands and safely have your cash stored away until there's a new opportunity. All right, so somebody brought up a really interesting ETF I've never heard of before. And I think they brought it up because I mentioned this in the video the other day, saying how much I don't like those fancy ETFs that say they hedge positions, they're selling covered calls, like all that stuff. I've never been a fan of them because I've never found one that actually works well, that protects you. So this person brought up this ETF here, TLTW, which is new to me. I looked it up. It's like the TLT long-term treasury bond, but it's a buy right strategy. So it's trading options to try and generate more return or stability, all of that stuff. So let's take a look at the chart because this is the problem. If you buy into any of those covered call ETFs, the hedged ETFs, anything that does that, you're going to find this problem. Brian and I talked about this in detail in our mentoring session last week. There's really only kind of one way to hedge that doesn't really cost you anything. It's one way that Brian shows using options. But all these ETFs that do it are not very safe. So take a look at this. This is the TLTW ETF. Now, it doesn't go back very far because one of the key points here is you're going to realize when a fancy ETF comes out, it's usually after a big move has kind of happened, and usually it backfires shortly after that. And a lot of times these things are built to have a lot of decay and value. So, obviously bonds have been going down. Let's just compare these two charts. I'll just kind of jump right to it, keep it short and simple. So long story short, if we go way back in time, the bond market broke down and it was well into a bear market phase. And what happens after that? We tend to see people come up with creative, lucrative ETFs to try to take advantage of this stuff and sell it as a financial tool. So the bond market put in a major top, it sold off and then started to break down. And then suddenly somebody's like, hey, let's make an ETF for TLT because everybody loves it. It's a high volume play, but let's do some option strategy to try and make it pay higher yields, higher returns or dividends. And so usually that'll come after it starts the market. And if we take a look at the price action here, what I kind of want to show is simply, if you look at the highs from these charts, I'm just going to compare down to this recent high and this low, down to this recent low, which is kind of hard to focus on here. But if we take a look at these and we just go to this high. So the core problem here is if we were to take a look at the high from the same time frame roughly all the way to the high that we saw just over the past week, TLT is down about 16%, 15 and change. If we take the lows and where it is today, it's down about 3.25%, which is typical. TLT does have quite a bit of volatility. And if you did this, you'd be earning your 4.35% interest and you can just hold on to it. Now, if you get all fancy and you think you can make more money doing some option strategy on it and using an ETF that has crazy high expense ratio and all this stuff that kills its value, because put it this way, anytime you hedge, almost every time when you hedge, it just costs you money. Hedges are there in case something bad happens or it's this bad strategy. It'll just keep costing you money. Now, look at the difference. You get into something that you think is going to pay you a higher dividend, and maybe it does pay you a little bit higher dividend, but you're down twice as much in the best case scenario. The worst case scenario, you're down almost 8 times more than what the TLT is. So just be careful. If you buy something that sounds really good when it comes to ETFs and they're selling covered calls and they've got this option strategy, they're usually garbage. You're best just to hold TLT or wait for it to turn up and then get into it. And then you don't have to waste all this time. Or go to BIL. It pays you this pretty much the same interest rate with no downside risk. And then when bonds do turn up, you just jump into bonds and you make the yield plus the gain in share price. So don't get fancy with this stuff. It will generally cost you money. Now, let's take this a notch further and go to the precious metal space with miners. Check this out. So here's the top chart of GDX. And we saw a pretty significant bottom in the miners. It had a beautiful initial big impulse move, breaking all kinds of previous highs. And then it came back down and stabilized for a very long time, took forever to unfold. It started to get some traction. We had COVID, which created a big blip here, got a lot of people's attention, and it put in a massive rally, which is pretty exciting because it could be the start of something really big. And then what happens is somebody gets really fancy. They're like, hey, there's a lot of interest in this sector. Well, let's create an ETF so we can get tons of money under management and we'll make a ton on running an ETF and managing it. And so shortly after this big run, it got everybody's attention kind of back here. And then, of course, it really started to muscle higher. This is the weekly chart. And then suddenly somebody finally puts in the work. They create an ETF and they launch it. This is the 3X gold miners leveraged ETF. And just look, you get into this, let's say you just get into it at the same time roughly, somewhere right in here. You look at where GDX is now. You're up 95% from that play. I'm going to get this tool here. 95% if you did the GDX. If you did the same thing over here and you get into it, you're down 46%. And usually these fancy ETFs come out right after a really nice run, and they just backfire. And here you think you're going to make a fortune, and you don't. I mean, it's unless you buy it right before the move, you can make, obviously, if you can time it and play these breakouts, you can have some very substantial moves. But again, when something new like this comes out after a big run, you got to be weary of those. It's usually a crowded trade. They're playing off mass psychology. They're trying to build an instrument that they can sell and make money with. And usually it's right after a herd mentality, a type of crowded play. So people who get involved back over here when they launch it, end up being down 50%. Meanwhile, you could have taken a much lower risk position and be up and had a much less painful experience. Now check this out. If we look at what happened let's go back just after the big rally that we saw after 2008. We saw the big rally in gold miners. They took off, and let's just squish this one down a little bit. This is Nugget. So after this multi-year run to the upside, finally somebody came out with a 3x mining ETF. This was obviously before this one. They said, holy crap, this is an amazing space. Let's create an ETF. We can make a fortune. They create this product, and shortly after, it really just trades sideways. It does make a couple nominal new highs, but then it sells off, and look at it's dead. Like, unbelievable underperformance. We could just take anywhere in the middle here and you drop it down to the value it has here. You're down like 99% on your money. It just keeps losing money. These are terrible investments. Let me rescale this here. Again, if you happen to buy it on the upswing, you can do very well because it's triple leverage, but you just have to be very careful because they generally, in the long run, as you see, as you go back in value here, they lose value naturally. Even with a huge move in the stock market, they will post some big gains, but just be careful because these leveraged ETFs generally carry a lot of danger, and most people don't know how to manage positions, or they get over positioned with too big of a position and they use leverage on top of that. And usually that's how people blow up accounts. I've blown up accounts, 3 accounts with leverage. 2 of them were on futures, and I'll tell you, it's not fun. I'd much rather consistently grow my money. It's boring. It's not quite as exciting, but you end up growing your account and not going through the roller coaster. Last but not least, few of you wanted uranium, so I pulled up the 2. We got the Sprott URNM fund at the top. These are weekly charts. We got the bottom one, which is URA, which just gives us a lot more track record to go off of. If we zoom into the price action, it just shows in the bottom the volume, how much interest has come into these over the past few years. They were dead for a long time. And now they're starting to get a lot of attention, and the volume continues to really ramp up and hold value. So there's definitely a lot of interest in this space. My analysis on this is, it's in a strong uptrend. It definitely has volatility. At any point here, it could reverse and sell off. If the stock market does have a leg higher, I do think we'll probably see this push higher as well. But we're in this phase here where we just have to see if this is one of these or if it is one of these where it sells off and heads lower, right? So that's the big question. Is this a top or is this a pause? And we won't know until it clearly picks a definitive direction based on these wicks. There's a lot of price action through here, some huge wide range. May not look big, but obviously these are percentage-wise, these are pretty big ranges back and forth. Let's just see what this one here is. So they carry volatility, but overall, they're still in an uptrend. They're trying to stabilize a lot like gold. I think we could see them have another push higher, or at least back up to the highs, and then see what it does from there. Anyways, that's it for now. Talk to you soon.